The inspiration for this conversation was the piece you wrote on the 2019 debt diet. Walk us through the evidence of that taking place already.
Well, first, credit to Peter on coining the phrase that we've been using a lot this year, and that's exactly been the theme. And I really thought of it first when we were back in January, when it was the week that AT&T and GE were reporting earnings, and these are companies that we've been looking at the debt for so many months on both of them for very different reasons. You know, for GE, it's been the legacy finance arm that's left them with all the debt that they have, and for AT&T, it's been intentional leveraging, mostly for acquisition purposes. And now we're finally getting to this year when, yeah, we need to look at these balance sheets and really strengthen up the metrics a bit. And they're both committing to paying down in the upwards of $20 billion of debt this year.
So, Peter, I'm going to use the I word that I hate hearing, which is idiosyncratic. Are these just some unique idiosyncratic stories, or is this a broader market story?
You know, I think it's a broader market story. I think we lived off a very cheap debt. So as that debt's getting a little bit more expensive, companies have to think about what to do. And then on top of that, you did see some stocks really hammered. You saw GE and Budweiser stocks really hit hard last year because of debt concerns. So I think that was a wake-up call, and corporations across the board are saying, hey, we've got to be a bit careful, and shareholders are actually going to reward us for being balance sheet helpful rather than, you know, using the balance sheet.
Let's be really clear here, though. What you're spelling out is the incentive for these companies to do this isn't coming from the debt market. It's coming from the equity market.
Well, I think it goes hand in hand. When the debt market kind of raised the red flag, equities responded very dramatically. So they go hand in hand, and together, right, with the capital structure, that's what companies are having to manage to. But the first step right now is fix your debt, make sure debt side is comfortable, and we've been given a huge window of opportunity where credit spreads are very tight again.
Yep.
Overall yields are very good, so companies are able to issue a lot of long-term debt, clean up the front end. It's a really unique chance, I think, for these companies.
Is it a window opportunity or just another time for complacency? And I'm trying to understand how much longevity this story has, or whether the change in price, the V-shaped recovery in credit, just means the story changes again, Molly. Why is this sustainable? Why do companies continue to do this through 19?
I think, like Peter said, you know, it's the equity market, it's the debt market, it's also the rating agencies. We have those lingering in the background as well, that a lot of these companies, not the two that we just mentioned, but are rated a bit lower in the BBB stack, some of them with negative outlooks, and those fallen angel concerns very much alive and well. Some people flagging it as a much greater risk than it, and many others are expecting it to be. So certainly there are like these compounding pressures right now that many corporate treasurers are mindful of, I'm sure.
So there is this line in the sand between investment grade and junk, and it's triple Bs. There's the line in the sand, then there's double Bs. If you ask anyone outside of fixed income, the biggest risk in fixed income markets, in credit specifically, they might tell you triple Bs. Ask anyone within fixed income if triple Bs are a problem. Very few will tell you it's a problem. Why is anyone saying this is a problem?
I think people are saying it's a problem for exactly the wrong reasons, and that the triple B market, I think, is actually looking to get bigger more than smaller. I think a lot of people look at it like, you know, the fallen angels are going to take so much debt out of this ratings tier, but we also have a lot of rising star candidates, so that's companies that are rated double B that are looking to move up into investment grade. And the real concern has been the ratings downgrade from single A down to triple B. So if anything, it's these two groups of companies that are coming into triple B that could make it bigger rather than a smaller universe.
And I think that's fine. I think over the last 3 years or so, companies have realized triple B is probably the optimal place in the capital structure. If you're single A rated, you don't get much of a benefit from your bond yields, and you have much more restrictions to deal with from the rating agencies. So that's why I think we're going to see continued M&A and stock buybacks from the single A companies as they're willing to push down to triple B. The corollary of that, though, is no one wants to move down to double B, so you're going to fight aggressively to stay to triple B, and you're going to see double B companies move up.
So essentially, there was a big incentive to run a triple B balance sheet. So the CFO and the C-suite got together and said, guess what? We'll run a triple B balance sheet. Is it easier to say I'm going to go down and run a triple B balance sheet than it is to say I'm going to go up and run a tighter balance sheet?
It's definitely easier to say that and to execute that. Though on the one thing I do want to bring up, people kind of talk about how quickly all these companies could go from triple B to junk to default.
Yeah.
They were way overestimated. These things take a long, long time. Any decent investment grade company has a lot of assets to deal with. There's just so many ways. So this whole theory that you could get this sudden rash of downgrades and this huge swelling of junk market from triple B, I think it's just wrong. These things take a long, long time to play out. Even when we went through the financial crisis, relatively few investment grades got downgraded and almost none defaulted. So these things, Radio Shack, took decades.
Well, let's talk about how this is going to play out in terms of price for the rest of this year. So that line of the sand we talked about between triple Bs and double Bs has become quite tight. The whole credit universe has rallied. Triple Bs maybe less so. And now I'm hearing more and more whether that's an opportunity to be long this space that so many people worry about. Is it, Peter?
Yeah, I think you're supposed to be long triple Bs. I think the double Bs have benefited a little bit too much by the fact that you've had a lot of high yield fund flows. And when the high yield investors get it, double B is kind of their safe spot. So there's been a lot of money pushed into double Bs. I think you're going to have to see some issuance in the double B space, see those spreads widen. I like triple B better than double B right now.